So I think we're in a slow motion fiscal crisis. I don't think, a year from now it's going to be particularly different, maybe even 2 years from now. But I do think over the next 5+ years, this is a long drawn out fiscal issue. Back in 2008, that wasn't a sovereign debt crisis. That was a private sector debt crisis. And then a few years later after that, Europe did have a sovereign debt crisis. But when you have a sovereign debt crisis in a very deflationary era, printing money kind of fixes it, and those consequences are not as immediately apparent. But when you have overall kind of larger deficits, more structural background inflation, fewer inflationary offsets, like, China in the 2010s was a very deflationary force on global manufacturing, for example. And even though they still are, the rate of change is not what it once was. It's kind of like a lot of that low-hanging fruit has already been picked. We've already done a lot of that offshoring, and if anything, it's a political issue to try to reshore some things now. And so where you can run into what would be more publicly perceived as a crisis is if you have these ongoing debt and deficit issues on the public ledger while you have high inflation. Because if central banks have to end up accommodating those deficits, and that's kind of how this always works at the end of the day, you could get stuck with above target inflation and then everybody complaining about it, which makes it more of a political crisis. And you could get like the emerging marketification of some of these key developing market currencies, which is that it doesn't mean that everything blows up in a year or a few years, but it means you're stuck in this kind of hot environment of debasement happening at a rate that most would consider unacceptable.
In recent data, the US manufacturing sector has been in recession for over a year and a half, while commercial real estate, particularly office properties, faces a deep depression. Lyn Alden highlights how the service and travel sectors have managed to remain strong, but the broader economy is hitting a soft patch. Consumer spending and unemployment numbers are beginning to lag, raising concerns about the overall economic health. With fiscal deficits now exceeding the scale of new bank loans and corporate bond issuance, Alden argues that we are entering an era of fiscal dominance. This shift threatens to accelerate interest expenses and amplify the federal deficit, posing significant challenges for both domestic and international markets. As inflation stubbornly remains above 2%, central banks find themselves in a delicate balancing act to maintain economic stability. Alden warns of a slow-motion fiscal crisis that could plunge the US into a prolonged recession, with potential ripple effects across the global economy. This fiscal imbalance may lead to a scenario where above-target inflation becomes the norm, sparking a political crisis and the emerging marketification of key developed market currencies. Will this evolving crisis lead to widespread economic turmoil, or can policymakers avert disaster?
I think that so the economy started hitting a soft patch. I mean, there's one thing about this cycle is that there are parts of the economy that are on very different cycles. So for example, manufacturing has been in a recession for basically over a year and a half. Obviously, commercial real estate's in effectively depression, especially in office properties. But the service sector's been good. The travel sector's been good. There's a lot of areas that are still doing fine, and the labor market has been strong. Now, in kind of prior months, some of those stronger areas started to lag a little bit. Consumer spending numbers have been a little bit on the weaker side. We talked about unemployment's ticking up, a little bit softer on that front. However, the latest quarter's GDP came in fairly strong. And so some of that soft patch might actually be kind of stabilizing. It doesn't necessarily show that it's accelerating in the past month or so. So I can see why he doesn't want to pivot quite yet, because there were prior quarters where they thought they had things under control, and then a quarter later they have to kind of hawk it back up with their language again. And so I think he doesn't want to be in a position of committing and then having to change expectations. Instead, he's kind of leaving it vague, letting the market price it. And of course, they can send out Fed officials to talk the market one way or another as the data develops over the next month or so.
Elaborate on that?
That's my view. So in this cycle, the economy has been more resilient than many expected to rate hikes. And part of that is because I would argue that we are in fiscal dominance, which is to say that fiscal deficits annually are bigger than the amount of new bank loans per year, or even the amount of bank loans and corporate bond issuance on net in a year. And so interest rates really serve two main purposes. One, they make your currency more attractive to foreign holders, or they prevent domestic entities from fleeing to other currencies, like you might see in Japan, for example. So one is they help stabilize your exchange rate, and two, they can affect how much lending happens in the economy. And for the past 40 years, money creation's been dominated by lending. But as we've gotten more into fiscal dominance, lending is actually, in some ways, a smaller component of the economy than the fiscal deficits. And the federal debt is generally fairly short duration. It's an average of like 6 years, but it goes from very short all the way up to 30 years, and so it's pretty front loaded in the first few years. And so the interest rates hikes increase their interest expense and their overall deficit at a faster rate than it impacted homeowners and investment grade corporations that on average locked in longer duration debt. And the key emphasis I've been putting on is that if we cut rates a little bit, but we don't get a lower low, there's not that many mortgages that would want to refinance at those mildly lower rates, because there's not been much mortgage volume originations at these higher rates anyway. There was a big refinancing wave back when they were very low. And so if we get like a higher low in interest rates for corporations, for mortgages, that only has a moderate effect on kind of stimulating parts of the economy. The areas where it would be more impactful are small businesses that rely on bank lending. But again, only around the margins if we're talking about 3 cuts or something like that. It would affect, obviously, commercial real estate. I think it would impact emerging markets, because if you soften the dollar a little bit, those countries with dollar-denominated debt have a little bit more breathing room. So it's not that it's not impactful, but I think a higher low in interest rates, kind of like how we had a higher high in interest rates this time, would give us just overall less stimulation on the economy than most people think. So I don't disagree with current market pricing. I think there's a pretty high chance that they will, but I'm not super high conviction on it, because if we get a month or two of things that are not as soft as they were a couple months ago, then I can also see them pushing it off. I think my main view is that whether we get a 25 basis point cut in September is not really going to affect any of my key investment decisions. I think they expect to see the trend continuing, but from still a fairly strong base. Because if you expect to see substantial labor weakness, then you probably would expect faster rate cuts than just, a 25 basis point cut here, another 25 basis point cut here. Markets tend toward being moderate in the sense that they don't want to price in rapid outcomes. Historically, when the Fed cuts, they tend to get pretty aggressive pretty quickly, because they're usually cutting in response to fairly bad economic data. Now, in this case, they're cutting from a very high level in response to an inflation spike, which is different than most of the past 40 years. So it's more possible that they could have mild cuts that would still be somewhat historically unusual, in our investment lifetimes. My overall expectation is that they will probably have a higher low in interest rates in this cycle, whether it starts in September, whether it starts in the next meeting, whether it starts in early 2025. I don't have a very high conviction, other than to say that I think there's too much attention placed on those details. It depends how surprising that is. I mean, a lot of that will be priced in based on what the market's already looking at. That's not we're seeing kind of a range-bound dollar index, for example, because the market's kind of pricing in, not super dovishness, but some degree of cuts in the foreseeable future. And so I think basically where that would impact is decently beneficial for certain emerging markets, decently beneficial for some of the more cyclical side of the economy. In my view, less relevant for the very large companies, and not particularly relevant for the majority of the real economy, especially when we're talking about less than a full percentage points of interest rate cuts. So it's possible, but I think that with the size of the structural fiscal deficit that we have now, as well as some of the frictions in, say, global supply chains and kind of competing great power narratives and, views around reshoring, I think that inflation on average is more likely to err above 2%. than below 2%. Back in the 2010s, they were ironically lamenting that they couldn't reliably get inflation the way they measure it above 2%. Now the stickiness might be on the other side of that, and so I do think we could see a higher low in rates, which means maybe we go back down to 3% or 2%, but I think it's going to be harder to get back down to 0%, which I think is many ways a good thing, because there should be a cost of capital. Basically, capital in the present should have a different cost than capital in the future in most healthy markets. So I think we're in a slow motion fiscal crisis. I don't think a year from now it's going to be particularly different, maybe even 2 years from now. But I do think over the next 5+ years, this is a long drawn out fiscal issue. Back in 2008, that wasn't a sovereign debt crisis. That was a private sector debt crisis. And then a few years later after that, Europe did have a sovereign debt crisis. But when you have a sovereign debt crisis in a very deflationary era, printing money kind of fixes it, and those consequences are not as immediately apparent. But when you have overall kind of larger deficits, more structural background inflation, fewer inflationary offsets, like China in the 2010s was a very deflationary force on global manufacturing, for example. And even though they still are, the rate of change is not what it once was. It's kind of like a lot of that low-hanging fruit has already been picked. We've already done a lot of that offshoring, and if anything, it's a political issue to try to reshore some things now. And so where you can run into what would be more publicly perceived as a crisis is if you have these ongoing debt and deficit issues on the public ledger while you have high inflation. Because if central banks have to end up accommodating those deficits, and that's kind of how this always works at the end of the day, you could get stuck with above target inflation, and then everybody complaining about it, which makes it more of a political crisis. And you could get like the emerging marketification of some of these key developing market currencies, which is that it doesn't mean that everything blows up in a year or a few years, but it means you're stuck in this kind of hot environment of debasement happening at a rate that most would consider unacceptable.